The stock market will crash. It's happened time and time again. This is the scary truth. However, it doesn't have to be a bad thing. As long as you're properly prepared, you can benefit from the chaos.
What if I told you that the Federal Reserve's next move could make or break your portfolio? In 2025, the Fed is expected to cut interest rates by 0.50%, a move that could send shockwaves through the stock market, bond market, and even your savings account. But here's the question. Will you be ready to profit or will you miss out? Stick around as we break down the secrets to capitalizing on falling interest rates, from bond strategies to stock picks, and uncover how you can turn the Fed's next move into your biggest financial win. 1. The setup. Why the Fed is cutting rates. Let's start with the basics. The Federal Reserve controls interest rates to manage inflation and stabilize the economy. When inflation is high, they raise rates to cool things down. But when growth slows or unemployment rises, they cut rates to stimulate spending and investment. In 2025, the Fed is expected to cut rates by 0.50%. Why? Because inflation is finally under control, but the economy is showing signs of slowing down. This is a classic soft landing scenario, and it's a golden opportunity for savvy investors. But here's the catch. Not everyone will benefit equally. The key is knowing where to invest and when. 2. The big move. Bonds are back. When interest rates fall, bond prices rise. It's a simple rule of finance, but one that many investors overlook. Here's why. Bonds pay a fixed interest rate, so when new bonds are issued with lower rates, the older bonds with higher rates become more valuable. What does this mean for you? Treasury bonds. Safe and reliable, these are a great option for risk-averse investors. Municipal bonds. Tax-free yields are hitting 15-year highs, making them a smart choice for high-income earners. Corporate bonds. Higher risk, but potentially higher rewards, especially if you pick stable, blue-chip companies. But bonds aren't the only game in town. Let's talk about stocks. 3. The stock market playbook. Falling interest rates are like rocket fuel for the stock market. Lower borrowing costs mean companies can invest more, consumers can spend more, and profits can soar. But not all stocks are created equal. Here's where to focus. Growth stocks. Companies like tech giants, think Apple, Microsoft, and Nvidia, thrive in low-rate environments because they rely on borrowing to fuel innovation. Real estate. Lower mortgage rates mean more home buyers and higher profits for real estate companies and REITs. Consumer discretionary. When borrowing is cheap, people splurge on cars, vacations, and luxury goods. But beware, not every stock will win. Companies with high debt or weak balance sheets could struggle, even in a low-rate environment. 4. The hidden gem. Dividend stocks. Here's a pro tip. Falling interest rates make dividend stocks even more attractive. Why? Because as bond yields drop, investors flock to stocks that offer steady, reliable payouts. These are the top picks for 2025. Utilities. Companies like Nexter Energy, NEE, and Duke Energy, DUK, offer stable dividends and are less sensitive to economic cycles. Consumer staples. Think Coca-Cola, KO, or Procter & Gamble, PG. These companies pay dividends, rain or shine. Healthcare. With aging populations and steady demand, healthcare stocks like Johnson & Johnson J&J are a safe bet. But remember, dividends are just one piece of the puzzle. Always look for companies with strong fundamentals and a history of raising payouts. 5. The wild card, gold and commodities. When interest rates fall, the US dollar often weakens. And when the dollar weakens, gold and other commodities tend to shine. Why? Because they're priced in dollars, so a weaker dollar makes them cheaper for foreign buyers. What to watch? Gold. A classic hedge against inflation and currency risk. Copper. Essential for renewable energy and electric vehicles, making it a long-term play. Oil. While volatile, oil prices could surge if global growth picks up. But be cautious. Commodities are inherently risky, so don't bet the farm on them. 6. The timing. When to act. Here's the million-dollar question. When should you make your move? The answer, now. The Fed's rate cuts are already priced into the market to some extent, But the biggest gains often come in the months leading up to the cuts. Pro tips: dollar cost averaging. Invest gradually to avoid timing the market. Rebalance your portfolio. Shift from cash and short-term bonds to stocks and long-term bonds. Stay informed. Follow the Fed's announcements and economic indicators like inflation and unemployment. 7. The risks. What could go wrong? No strategy is foolproof, and falling interest rates come with risks. Here's what to watch out for. Inflation surprises. If inflation spikes, the Fed could reverse course and raise rates. Market volatility. Rate cuts can create uncertainty, leading to wild swings in stock prices. Overvalued assets. Low rates can inflate bubbles in real estate, tech stocks, or cryptocurrencies. The key is to stay diversified and avoid putting all your eggs in one basket. The time is now. The Fed's rate cuts in 2025 are a once-in-a-generation opportunity, but only if you act wisely. Whether you're investing in bonds, stocks, or commodities, the key is to stay informed, stay disciplined, and stay ahead of the curve. So what are you waiting for? The time is now to position your portfolio for success. Don't let this opportunity pass you by.